Hi, welcome to Salty Investors, episode number 68. It is Thursday, February 29th. It is the leap year day. How's it going,
Yep.
Tim?
Yeah, pretty good. Don't have these too often, do we?
No, every 4 years. That's how you know it's an Olympic year.
Okay.
Same year.
Yeah,
Yep. So if you know anybody with a birthday on the 29th of February, you don't have to buy them another present for 4 years.
nice.
Yeah, there you
Yeah.
go. What do you got for us at Salt this week, Tim?
Well, it's on topic. Um, Pundits have mentioned the leap year could save us from the recession. The extra day this year will add an extra 6.6 billion to the economy, which might be enough to avoid a technical recession. Those finding it tough are not laughing at this thing, saying, it's just a rounding error. Why
Yeah.
stop there? Let's move all our liabilities to the leap day. So our books look great 3 out of 4 years. High time preference tricks only cause pain long term. Have you heard about this?
Yeah. Well, actually, I hadn't heard about that. I heard about it in the UK. Christopher Snowden from the uh, he belongs to a libertarian think tank over there. He was trying to get 29th of February moved to summer so that they have a longer summer in England. Yeah. Yeah.
Well,
So,
yeah.
and he did it as a troll, and like people were taking it seriously, going, "Yeah, that's a good idea." Uh, yeah, look, people, there's, time is time, but
Yes.
the people know. I mean, the reason we have a leap year is because a year, the amount of time it takes to go around the sun is actually 365 days and about 6 hours and 22 minutes. That's why we add 1 year, 1 day every 4 years.
Hmm.
Um, you know, it's not going to help. Hey, we're already in a GDP per capita recession
I
anyway,
know.
so
Yeah.
and that's the one that matters. Yeah.
Anything to make the numbers look good. You know how it is.
Yeah.
We'll kick the can down the road and we'll worry about it next time. So,
Yep.
what are you salty
Exactly.
about this week?
Nothing. I haven't got any salt. I was going to talk about the gender pay gap, but because I think I've spoken about that before and it makes me sick. So just if you think the gender pay gap is a problem, you've just disqualified yourself from a conversation about gender equality. The gender pay gap is a non-problem, and non-problems by definition don't require solutions. So stop talking about it. You're all innumerate morons. Um, so let's
Did
actually
you
get
see Rio's actually got more women?
paying more women. Yeah, yeah. But see all these pay gaps. So stupid. So the well, let's get into this because I know far more about this topic than anyone reasonably should. So the gender pay gap statistic, the official gender pay gap, comes from the average weekly earnings report, which is put out by the Australian Bureau of Statistics every 6 months. And that's why some idiot every 6 months writes an article about, oh, the gender pay gap's 14% and we need to do more, which we don't. That report, the Australian Bureau of Statistics, as every single Australian Bureau of Statistics release has an explanatory notes page that tells you how they collect the sample and all the statistical errors and everything. And one of those notes says you cannot use this report to compare the earnings of males and females because it does not include compositional factors such as occupation, age, hours worked,
Yeah.
all the things you'd actually need to figure out whether people were being paid the same for the same job. The Gender Equality Agency, which is an agency that sucks up something like $10 million a year and 90% of its staff are women. So, just get over that contradiction. Gender Equality Agency. Now, what they do is they go through all sectors and they say finance sector has a 20% gender pay gap. What they don't tell you is they're comparing bank tellers
Oh,
with corporate executives, right? And most bank tellers are women and most corporate executives are men. This is not hard. They're not comparing like for like in any of this stuff. It's all bullshit. No one has a problem with saying, a doctor earns more than someone on the checkouts at Woolies. But the moment you add gender to the equation, everybody loses their mind. Which is
yeah.
funny because Labor are the ones that are going on about this, and Labor thinks there's like 57 genders anyway. So I mean, what kind of gender gap are you talking about? You know, what about the people with penises who think they're women? Are they're women now? I mean, that's going to equal the yeah. It's such a stupid talking point. I don't know how it survives this long. It's ridiculous.
Yeah, I know. It just loses me with people. I'm the same thing as well. I just just find it hard to speak to people like that and think, have you thought about it a little bit?
Yeah. It's a good litmus test to people who just understand basic math and those that don't. It really is. It should be like a question with like when people go for jobs. Do you think the gender pay gap's a problem? Yes. Okay, you're out. Next. It's just be so simple. Anyway, let's get to the juicy stuff. We had a bit of economic data here in Australia. Retail turnover. Remember, we had a shocker in December. Was down 2%, and it rebounded 1.1% in January, which was shy of the economists were thinking it was going to be 1.5%. So year over year, it's up 1%. And remember, Tim, what's the big thing that's happened in the last year? We had about 4.5% inflation, or 4%. So retail sales went backwards to the tune of at least 3% for the year. That's a recession because it was pretty consistent throughout the year. Couple of the other discretionary retailers we talked about. Nick Scali a few weeks ago had a good result. Adairs, have a look. I mean, just have a look at the total sales down 10%.
Wow.
For the same time last year. Their result actually looked decent because their gross margin actually slightly improved. Well, it improved a fair bit.
Yeah.
So that's what held the result up. I mean, they were still down, 20% at the EBIT line. But the stock has rallied. And if you remember last year, do you remember last year we did a podcast just before Christmas and we said, is it time to buy retail? If this is as bad as it gets, is it time to buy retail? Well, Adairs has doubled since then. It was $1.20 something, and it's now $2.40 as of today.
Well, we're too greedy.
And on the back of not a great result. Not a great result, but it's pretty good considering the climate they're in. Sales are down that much. They improved their gross margin. They turned around the poorly performing business Mocha. Went from basically a break even to a 3.5 million EBIT profit. Not too bad.
So what's the market looking through here? They're looking through to the tax, the interest rate cuts and going to go, we're through the worst of it.
I mean, so this stock has doubled and it's still on a PE of 10, right? Okay. It's on a PE of 10. They're going to pay a 5-cent interim dividend, and let's say they pay another 5 cents, they're going to pay 10 cents. It's about, what's that? About a 4% fully franked yield. Not great for these kind of stocks. I think this one's run too far, quite frankly. Give it Dusk. Dusk, on the other hand, I mean, look, Dusk is about the same here. Sales down about 10%, gross profit down about 10%. They kept their margin up, but their cost of doing business went up a fair bit. Gross profit went down. Cost of doing business went up. I mean, they're at the EBIT line, they were down 40%.
Yep.
And they got smashed. They're at all-time lows now.
With? Who have you met that goes, oh, yeah, I'm a Dusk shareholder? It's a pretty small crowd, surely. It must be thinly traded.
Yeah, it is. I mean, it's not, it's a small stock. It floats under the radar. No one really pays much attention to it. There's not much incentive for brokers to cover it, but some of them do cover it.
Okay.
But it got smashed. It got smashed. It was around $1, trading $1 recently. Today it got down to 81 cents, I think, at some point.
Okay.
So
it's only been around for a couple of years, but hasn't it?
It listed at the end of 2020. So it's been around for about 3.5 years. So if you think about it, this is the worst environment they've ever faced. If you exclude that, the March sort of in March 2020, were they listed by then?
I don't know.
I don't think they were. I think they listed at the end of 2020. Yeah. So this is actually the worst environment they've ever faced. It's the worst, in terms of interest rates and just sales. So this is the worst ever been. This is the lowest the stock price has ever been, actually.
Yep.
And so I am you just said, do you know a Dusk shareholder? Well, as of today, I am.
Okay, sorry.
Yeah. No offense taken.
Okay.
As you know, as we've spoken about in the past, it's not because I think this is a quality company. I
Mhm.
think I'm buying it, at or close to the bottom of the cycle.
Well, we definitely
We'll
have to
see.
watch it now.
Yeah,
So,
we'll see how it goes.
yep.
I could be on here in a couple of weeks, after they come out with another profit warning and be, dumping it at a 40% loss. Who knows? But, I'm just, I have a little bit of, I'm just sick of sitting on the sidelines. I'm going to
Yes.
have a stab at one of these things. I didn't have a stab at Adairs when we
Mm.
noticed it at $1.20 3 months ago, and I'm having a stab at this one.
Yep.
Just interesting on the outlooks, sort of same thing. So that's for Adairs' first 7 weeks of the year. Group sales are down 10%. Mocca's up 4, which is good. That's their small. It's only a small part of the business, but it's good that because it was really underperforming. So it's holding steady. They say customer traffic significantly lower than the same period last year. Sales for the first 8 weeks remain challenging. There was another point they put there that the moment they take their sales away, the customers just disappear.
No.
Like people are really just
Mm.
buying when the sales are on.
Yep.
Dusk, same sort of thing. They're down, let's call it 8%
Mhm.
from the same period last year. Challenging, expected remains over the balance of 24. Outside store traffic remains soft at -6% PCP. So again, it's like, is it going to get any worse? If this is the worst, like if it was the worst we saw back in December, well, Adairs was a good buy. But today, with Adairs trading where it is, if you think these things are going to survive, I mean, Dusk has about $30 million in cash on the
Okay.
balance sheet. They have zero debt.
Ah.
Of course, some of that cash is tied up in working capital. There's payables to pay and sort of,
Mm.
but if you think it's as bad as it's going to get, and I don't know, maybe it gets worse. We know unemployment's ticking up, but
Yep.
yeah, I thought I'd take a stab anyway.
So what sort of dividend is that on Dusk?
Well, they paid 2.5 cents for the half.
Okay.
So if they pay another 2.5, if they pay 5 cents for the year, 5 cents on 80 cents, So
Not too bad.
yeah. But a couple of years ago, they paid 20 cents for the full year. Now that was 2021, and you wouldn't expect a repeat of that. But all they've got to get back to is 10 cents a year, 5 and 5
Mhm.
per half, and you're already at, at what, 12%
Yeah.
yield or something. So that's what we're hoping for.
Yep.
We shall see. CPI didn't really budge much. I don't know if you know this one, Tim. Didn't that downward trend that everybody's talking about, and it's time to cut rates, sort of just flatlined.
Yep.
The headline number just sort of flatlined at whatever it was, 3.6 or something, isn't it? 3.7.
Mhm.
The trim means just down below 4, and excluding volatile items still just over 4. So
Yeah,
it's not.
non-event.
Yeah, I didn't see the kook. Didn't see the
Ah.
Koukalis, because remember last time he came out and said could be a rate cut in March. I think you're dreaming, sunshine.
Yep.
This is the, we haven't put this up for a while.
Mm.
The implied expectations. I think 25 basis points lower brings you out to September, October. So that's what the market's pricing, going to cut around that time.
Yeah. It's
Which
getting
is
late in
later
the
than a
year.
lot of people. Yeah, well, a lot of the economists was, they're sort of saying first half of the year, May, June, I think is consensus. So we'll see. I mean, New Zealand's
Yes.
way ahead of us, and they still kept their rates unchanged. Was it
Mhm.
this week or late
Yeah,
last
yeah,
week?
they did this week. Yeah, they'd
Yeah.
kept it unchanged, so which sort of spooked us because we're thinking, what are they going to do? If
Yeah,
they hiked,
they're the
we were
canary
going
in
to
the
have
coal
to.
mine.
Surely, there was no way in the world. What are they seeing that we're not? But
Yeah,
they didn't, so that's given some reprieve to our market. So hopefully the rally can
yeah,
continue.
yeah, yeah. Yeah, I just, GMO does this a lot. And
Yeah,
quite frankly, they've been saying the same thing for a long
I
time.
know. I've seen this chart
Um,
before.
US large cap. So that's a 3.5% return for the next 7 years, right?
Mm-hmm.
Is that real return forecast? Real returns. So is that annual return or is that
Yeah,
over 7 years?
it'd have to be annual, wouldn't it? Surely.
Hmm. Yeah, I'll have to check it.
But I'm sure I've seen this exactly the same chart the last 2-3 years or whatever.
Yeah.
And that
Okay.
hasn't happened. So
Yeah.
if it's,
Well, yeah.
backloaded to the next 7 years are going to be, pretty brutal if it's going to come to pass. But
Yeah. And I still can't. And the same thing with emerging markets. Like for how many years now people said emerging markets, that's the place to be because it hasn't been.
I keep looking every time I see this. I go, oh, I'm going to have another look. I go, have another look. I ended up like in India looking at some Unilever in India or something. I go, oh, what am I doing? Like, this is just, I got no idea about the geopolitics and, what are the interest rate environment over there and is it stable? Like, no wonder people invest in the US. So,
devil you know.
Mm-hmm.
Yeah. Well, yeah, I just thought, Nvidia's the poster child. Actually, there was an article in Livewire Markets this week comparing Nvidia to Cisco back in 2000.
Yes. Mm-hmm.
So this guy, this was in the FT in England. So this guy said he pulled out a discounted cash flow model and plugged in Nvidia's numbers, and to get to $740 a share, which actually I think it was up to 780 at one point. The share price simply requires that the company maintain a monopolistic-like operating profit margin of 55% for the next decade, while also growing sales tenfold from 60 billion a year to more than 600 billion. For context, the entire industry sold 527 billion worth of chips last year. So they'd have to have, I mean, the market's going to grow, but they'd have to have, nearly 90% of them, or 80, 90% of the market. Just to
you're forgetting the TAM's going to increase. The TAM's going to increase.
Ooh, TAM.
Yeah. Like, we're going to have chips in our head and, like your cat's going to need a chip on it, like they're going to be everywhere.
Yeah. So it's similar, the expectations put on Cisco back in the day were ridiculous, and it turned out to be the case. But the real question is, Tim, why haven't you shorted this, you coward? I don't like getting in front of freight trains.
I feel a bit bad for you, like I told you my story. You think, oh, we went through a couple of booms, the graphics card boom, and then we went through the, mining currencies, electronic currencies, and then now we've got the AI boom. And it's just like, well, what's the next one? And it doesn't seem to matter. It's just this is going to continue to grow forever. So maybe it's right. I'm going to need millions of, cards forever, but it just seems to be, very hard to predict what's going to keep the growth going. That's all. Could be wrong.
Yeah. There was a story out. Did you see that story about Klarna? Was it that that tested AI for its customer service calls, and customer service calls went from an average of 11 minutes to 2 minutes. The satisfaction with the calls was slightly higher than humans, and they've got 700 customer service people that they can just replace with AI. No, it was AI was handling 700, the equivalent of 700 customer service people. Yeah.
Wow.
Yeah. So I don't know if that's I'm always skeptical of those kind of claims. They sound
but you just look at Amazon, for example, and you look at the head count at Amazon and you're like, wow, this is insane how many people they employ. And you can see AI going to eat that. It's going to eat that lunch for sure. Like, repetitive tasks that aren't that super complex. But do you pick something like NVIDIA or do you pick Amazon? Like for me, it's like, well, I don't know if these guys are going to be the winner, but could be wrong.
Yeah. All right, let's get on to Texas Pacific Land Corp. Tell us all about it.
The last few weeks, You put up a chart showing the divergence between energy stocks and the top 10 in the S&P 500. That old guy in Omaha, Nebraska keeps buying Oxy in plain sight. Now he owns 34% of it. So am I missing something? Current narrative is that there's huge tailwinds due to renewables. But are we getting ahead of ourselves? About 43% of oil goes into transport gasoline. And the forecast for electric cars in a decade is difficult, but it could be between 40 and 70%. So let's look at 5 years instead. Currently, EVs are about 20% of new cars, and it looks to increase to 40% by 2029. So that would mean a halving of transport oil demand for new cars. This is only for new cars. There's 1.45 billion cars currently on the world's roads, and only 80 million or 7% were built in the last 12 months. So about 1.4% to 2.8% EVs per year are added to the total fleet over the next 5 years per year. So yes, there is a headwind with new cars going to be electric, but there is a huge gasoline install base. Unless there is some huge battery development to decrease cost, or the existing fleet of gasolines decreases more than 2.8% per year, I don't see much change. Other uses of oil are unlikely to be replaced by renewables at this stage, like planes and trucks and things like that. If disposable income doesn't increase and interest rates stay moderate, electric will have the same headwinds itself. So can I look at 5 years? With oil demand, I'm pretty sure I can, assuming there's no recession. In the past, we looked at Blackstone Minerals, which was a capital light oil and gas rights company. Today, we're looking at Texas Pacific Land Corporation, which is similar, but also has water rights. Texas isn't run by commies, so they value private property rights, and that is unlikely to change in the next decade. So it's fairly safe to invest in this type of model. A capital light royalty model means you're missing out on huge gains, but there's much less risk. As a side note, most CEOs are capital allocation vandals as they invest too much in boom times. So very little is accretive to shareholders at the end of the day. So you're not really missing out on the boom times. Let's look at the numbers. Shares outstanding are decreasing due to buybacks. They employ 100 people, so revenue per employee is great. Employer growth is well under revenue growth. On a PE and price to free cash flow basis, it's about 30% from the lows in the last 6 years. So you're paying about a 25% more than the S&P 500 average. Return on invested capital and margins are criminally high and stable. Growth is outstanding. Little dividend with low payout ratio. Hey, found one. Interest coverage is laughable as they have no debt. Let's flip over to balance sheet and cash flow. They have a net debt of 730 million. So nice war chest if things go bad, or they want to increase buybacks. Free cash flow has been going nicely except for COVID and in the last 12 months with softer oil prices. In COVID, it dropped about 50%, but it recovered quickly. The current catalyst I can see is to get to $50 a barrel of oil, which you sort of need for this to drop, would be, the economy slowing, but Russia's still flooding the world with oil to pay for the war. If I assume a 15% growth going forward, the price today seems fair, but at 10%, it's about 30% overvalued. Natural growth is hard to come by as there's nothing management can do, as it's basically a commodity. The problem for me is that I can only see it as cyclical. So it requires a 30% discount or margin of safety from the price to 6-year price to free cash flow low. So that's a massive 60% drop from today. Maybe I'm being too greedy, as COVID really was the cyclical bottom. So I should be buying it at the price to free cash flow of 18. So only a 30% drop. What do you think?
Yeah. I mean, I like the business again, but same as you. It's cyclical. I'm glad they don't have a big payout ratio. I mean, look at the returns on invested capital returns on equity here. It's ridiculous. Look at the margins. Gross margin of 85 and an operating margin of 80.
Yeah.
How ridiculous is that? I mean, these guys just clipping the ticket, aren't they?
Yep.
The developers come in and spend all the money on the infrastructure, and these guys just charge them a fee.
Yep.
It's beautiful. I'd like to see. It would be nice if we got a little worse than the soft landing scenario. Oil falls to $50, like you say, or thereabouts, and this looks good.
Yeah, and look, you can see it's been around since 1871. You know, even I don't remember that. You know, so like buying land is a pretty good investment over the super long term. As you can see, these guys are, you know, obviously got some home runs here. Like they don't have to do anything. Employing 100 people, how hard is this business to run? Like it's like they could double their capacity and, you know, to hire 110 people or something. You know, just the economics are just insane for these royalty type businesses. So, and if it does go bad, you know, as long as you can hold out for 4 or 5 years, I've got a war chest there to probably do buybacks at the right time. So they keep those buybacks going when the price has fallen through the floor. Not like they have to do CapEx spend or anything. Like they just like they're clipping the ticket, like you said. Yeah.
All right, ladies and gentlemen, there we go. We got an energy play for you, Texas Pacific Land Corp, and we will see you next week.